Yeah, I'm losing my edge.
Today's conversation, though, Michael, is based around hedging, not the most interesting trade in the world, but something that comes up very, very frequently in lots of different forms with the growing interest in gambling, Michael. This is something that I think is an internal struggle for a lot of people and is becoming easier for them to do, which is like, oh, I bet on this team for the Super Bowl, and maybe I bet on them a month ago, and the Super Bowl is coming up this weekend. Should I hedge? Or I bet on them going into the game, and I can live bet it at half, and I can hedge there. This is actually an idea that maybe people are learning from stuff like gambling or everyday life that's been around finance forever. And it's actually one of the biggest use cases for futures. And today I want to talk about just the case for hedging and investment. And thankfully, the small exchange products are perfect for it.
Mm-hmm. Yeah, I think it's a great topic to dig into. You're right. It seems like, decades ago, hedging was this nascent term no one really knew much about unless you were an institution, a cargo company or whatever you're doing, hedging inventory risk. Now it's so much more accessible and important.
Yeah, absolutely. And I want to, not go the traditional route and talk about like what a financial advisor would be like. Oh, well, we'll hedge your portfolio by buying bond funds and like, no, that's not the 2021 version of hedging, Michael. And I want to look at a 2021 market and the most, I think, applicable case for looking at hedging right now. Can you tell me what market this is, Michael?
Oh, yeah, I can. Oh, man, this is like I'm going to get it tattooed on my butt or something. This is Bitcoin, baby.
Yeah, this is Bitcoin. Michael is, people may not know this, but Mikey, being the youngest person at the small exchange, is also the no coincidence that he's our cryptocurrency expert here. Now, Michael, we've actually, before even kicking off the conversation, I want to get this out there. We are working. There's meetings as recent as today. There's meetings every day that we have here at the small exchange to get a small Bitcoin product out there. And that will be hitting your platforms very, very soon. So, look for that. But I want to go just back to the concept of hedging here, Mike. Being our small exchange expert, and I'm not asking you for like, where is Bitcoin going to be in a month from now and by the end of the year? But what I will ask you, as being the one who is around different cryptocurrencies, you live with a couple people who are specialists in this field, trading for large firms in the cryptocurrency sector. Do you see this market just going from where it has this year, 20,000 up to 40,000, north of 50,000 right now, and just continuing higher? Or do you see some turbulence? Like, is this a case, if I was long Bitcoin from January 1 of this year till right now, are you just holding, or is this a good case for hedging?
I think right now is a perfect time to hedge. I mean, you look back a few years when prices rallied up to 20,000 and there was this immense fear of missing out and then basically got cut in more than half.
Yeah.
And right now, just kind of a fun stat my roommates were sharing with me, we're over $1 trillion in market cap in Bitcoin. And you look at the largest assets in the world, Apple basically being number one, the largest company. Bitcoin ranks, I think yesterday it was 7. So that puts it among Google, wow, Apple, Amazon, gold, all these other traditional assets. I think right now when we're above 50K is exactly when you want to be looking at trying to hedge and diversify.
Yeah, and here's the deal, especially with our use case being futures and small exchange futures. Hedging isn't this idea of like selling out of your position and just being like, oh, I rode Bitcoin higher and now I'm done with it. Because I know a lot of people on Reddit and everywhere else will get mad at me and be like, oh, well, you just hate Bitcoin and you just want us to get rid of it and you want it to go down. No, I don't care. Hey, if Bitcoin goes up to 100,000, that's awesome, because the small exchange is going to launch really small futures on Bitcoin, and that's going to bring us great business for people trading them. I would love that. But here's the way things usually go, and I want to use some historical cases here, because all I'm asking for here in this making a case for hedging your investment, whether it's Bitcoin or stocks or anything else, is if you're even just a slight bit more active, Michael, you're going to be able to take a lot of this turbulence off the table, like that run up to 20,000. If you hedged a little bit with, futures coming from the small exchange, you would be able to ride that wave all the way down below 10,000 and actually reduce your risk on the table and actually make some profits in that short-term dip below there, buy back that hedge, and then still see all the upside that we're seeing here. And that's the case that I'm making for right now, which is not dumping out of your Bitcoin, but using these futures that are coming to your disposal to maybe, sell out of 20% of your position, 30% of your position. And then if it comes back down to 40,000, 30,000, you take that hedge off and then you ride 100% of that position on higher. So it's not an anti-Bitcoin conversation here, Michael, but just being a little bit more active reduces so much more risk. And I want to look at this market here in the past. Now, this is 2000 to 2008. Can you tell me what market this is? I'll let you, have a second to go look at the y-axis there. Maybe that'll help out a little bit. But can you tell me what this was in the aughts?
God, I'm not that old, Frank. I was like just a little baby in 2008. No, I'm just kidding. I don't know. I want to say maybe it's the SPY.
So this is actually the crude oil market. And this market got as high as $140 per barrel. And when it was up there, I've talked to people, who used to trade crude oil, and that was the only market they trade, akin to a lot of the people today who are cryptocurrency specialists, and they make a killing trading those markets exclusively that have gone much higher. This market, Michael, went all the way from $20 a barrel up to $140 a barrel. Ridiculous percentage returns. And then it went all the way back to $20 a barrel very, very quickly. And this, once again, I'm not saying Bitcoin is supposed to come down to, $500 at some point in the coming weeks. I don't think that will ever occur again. But these markets do usually falter at some point. And if you had hedged your crude oil position, say you got long at $40, $50, $60 a barrel, or even near the top there, $80 or $100 a barrel, you could ride that wave higher like a lot of people have in Bitcoin, these other cryptocurrencies, and even more kind of familiar probably examples to a millennial or someone who started trading in the last couple of weeks. GameStop, all you have to do is look at hedging part of that position, and you can really turn down a lot of this turbulence. And like I alluded to earlier, even have some short-term profits against those longs. Because, here's the thing, if you did get in early, like you bought crude oil here at $20 or $40 a barrel, Mikey, and then you hedged a good portion of that position up near the top, maybe you hedged 50 or 60 percent of that market can still fall to $50 or $60 a barrel. And you can actually be net profitable after that huge collapse. And this is really the case that you and I tried to make a couple of weeks ago when GameStop and AMC were seeing those huge moves to the upside. And cryptocurrencies a lot different because Bitcoin obviously has a lot of huge use cases in and of itself. I think it has a lot more staying power than a video game retailer or a movie theater company. But, you're going to see turbulence in this market inevitably, right?
Yeah, agreed. And I think you put it really well. You don't have to close your entire position and you don't have to be picking the top necessarily. That's the thing. It's not timing the market per se. It's just being more proactive while it's happening. It would be such a bummer to have gotten in at 20 here in crude oil, rode it all the way up above 100, didn't close, didn't take any profits, didn't hedge any of your exposure, and then see it back down to 20. And then you've held the position for 20 years and made nothing on it. I think adding just a little bit of proactive trade management can go a long way in some of these high flyers. Absolutely. And here's one of the most consistent high flyers in the market, which is, I don't even need to make you guess this one. Looking at the S&P from 2010 until February, March of last year, Mikey. And this wasn't a case where it, got cut in half, but it did get cut by a third here. And yes, it bounced right back. Not like this crude oil, and who knows what's going to happen in cryptocurrencies, and who knows what's going to happen in the stock market. I think this is a market that's ripe for hedging as well.
But here's the thing, and like a lot of people, I think, oh, I'm hedging 20 or 30% of my Bitcoin position. I'll never get that back. Or, I've got $5,000 in the stock market, and by hedging that amount, I'll never get that back and I'll never see the upside. No, active hedging, which is the what I'm making a case for here, just means, selling near where you think the top is. Right here, I think is a really just a really high number for the stock market. I think we will see some lower values by the end of 2021 here. You can easily buy back that hedge, like especially with small exchange markets, whether you're trying to hedge equity markets. You look at that small stock 75 and it's just a couple $100 in margin to trade, and you can trade it any day, any time that the US stock market is open here. It's just a matter of, okay, I'm taking some of my profits off the table. If this market collapses in the next week, the next month, the next year, I can buy that hedge back and then go back to 100% very, very easily. And this is where those active traders are so much smarter than the passive ones, because people will sit there and be like, oh, I bought Apple 3 decades ago and I just rode that wave higher, 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 and I never did anything with it. And that's awesome. That's what we advocate for. That's what you and I and everybody hopefully has some kind of money working in the stock market, and you grow that investment. But what's even smarter, what's even cooler, Mikey, is getting a little bit more active and not only riding that wave, whether it's Bitcoin or stocks or anything else, but as that wave turns over, you actually are potentially putting together some profits even in the downside.
Completely. And before futures and options, I would say this was a much more difficult task. Stocks were just so expensive. The correlations weren't really there on a lot of the products. I mean, now you can hedge with short options and actually make money if your hedge doesn't play out completely, because you're collecting some of that short premium. And with the futures too, you mentioned putting on a hedge like before a binary announcement, like a Fed's release. Say you have a stock portfolio, maybe you put on a small interest rate hedge with the smalls. I mean, that's so cheap to do, for one. Plus, you're not burdened by pattern day trading rules or any of that other malarkey, short sale restrictions, whatever it may be in the stock world. So it's really never been easier and never been more applicable as we print these SPX 5000 shirts. We'll see if we go there or not, but I think a good idea to have a little bit of short position, a little bit of hedge in any of these products.